All right, guys, we're back with another monthly market discovery video from Client First, where we go ahead and take a look at some market developments and insight using our Adaptiv Investment Management System. As always, these videos are for informational and educational purposes only. So we're using it for education and illustration. So they don't need to be used to make your own investment decisions. There is terms of use. You can find that on our website. It's also linked below this video. As always, we're going to make sure we focus on the three main factors of the Adaptiv Investment Management System. Those are price, trend, and strength. Price is the most important piece of data. Doesn't matter what's happening in Washington, D.C. Doesn't matter what's happening globally. Doesn't matter what the weather is. Doesn't matter how the brewers are doing. Really, all factors, opinions of market participants, whether they are shrewd or otherwise, are impacted or reflected in price. And price is really supply and demand, economic law. So more supply than demand, price goes down. More demand than supply, price goes up. And then we use that information, those facts, data, to identify trends and identify relative strength. And we can look at different asset classes, different sectors, different regions, and identify where there are trends and strength that we can take advantage of. So when we go through these videos, we'll always cover aspects of that in the assets that we're looking at. We'll look at trend and we'll talk about relative strength. And then we'll always come back to big picture, because really, week to week, day to day, even month to month, even quarter to quarter is really noise. When we look at the big picture, we can see that those types of moves are negligible. It's kind of like watching a movie with your nose on the screen. Case in point, here's the S&P 500 going back to 1980, and we can see that price has moved from lower left to upper right over that period of time. And we just finished a week here, a month, and you can see that there's barely any movement in price that's noticeable when we're looking at big term picture. And one thing I want to highlight here is a lot of times the financial media will reference a bull market that's over 8 years old, and they're really referencing, a start of a bull market here, and then today we're at this level here, when in fact we would kind of disagree with that information. Basically, the thought process being, if you look at this period here, this is an entire what's called consolidation of price, and for almost 13 years, price went nowhere. It went sideways. And so in reality, this bull market is not 8 years old. It's much shorter in nature, but because of financial media and maybe how they interpret things, they're saying it's 8 years old from here. We disagree. Again, we've gone sideways. I mean, if you think about investing in the year 2000, you made absolutely no return on your money all the way through 2013. That's a pretty poor period in time. It's very similar to 1960s, 1970s, which was anywhere between 10 and 15 years of sideways action, and then broke out in 1982 here and rose substantially over that time. But really, when we look at this supply and demand, price and action of the S&P 500, which is a decent gauge. Some people use the Dow Jones, which is 30 stocks, and we'll get into that in a moment. Other option would be, using something like the NYSE or the NASDAQ. Those are good indexes too. But really, when we look at this from 2000 on, we're only at a 54% increase in price from this period here. So think about that: 17 years with a 54% return. I don't think many people would think that that's quite a good deal. So I understand the thinking that when they say, oh, from 2009, it's been 8 years, that's understandable. But really, big picture, guys, when we look at this, this is a sideways consolidation where price went nowhere for 13 years. So zooming in here a little closer on the S&P 500, here we're looking at late 90s into current date. That previous chart was all the way back to 1980. This is a lot closer. This is about a 17-year period in time. And again, here we're talking about all the way across here. It wasn't until 2013 when we broke out to new highs. But the reason why I want to look at this is, remember, we're talking about the big picture. What are the trends telling us? How does the adaptive system work? And quite frankly, we need a way to identify trends when we're involved in the marketplace. And what we simply do is identify long-term trends and short-term trends. So here we've overlaid the long-term and short-term trends to make this quick and simple. And some of you are familiar with this from our previous videos and from our education. But the blue line here is the prior 40 weeks of information averaged, and the orange line is the prior 50 weeks of information. And we just simply make some rules based on this information, but it gives us some good idea on what the trends are. Right now, orange is above blue, and the trend remains up both on a short-term and long-term basis. And when we use the rules we're talking about, and it's quite simply, we identify when the short-term trend, orange, is below the long-term trend, blue, and both are trending down. This is not a time to be involved in the market. And so it's periods like this from here to here where we do not need to be involved in the market. You know, the great financial crisis, the adaptive system protects from the downside. This was a 57% drop in price. So if you think about an account, you know, if you've got an account that's got $1 million in it and it drops to $500,000, or let's say you've got an account that's got $50,000 in it, it drops to $25,000. You have to have a 100% return in order to get your account back to even. And when you're near and in retirement, it doesn't make sense to take a hit like this to your account and take distributions when your account has dropped in value. That's why we use the adaptive system. It fits in perfectly with the budget planning that we do. And we can avoid these major drawdowns, but yet participate in the market when it makes sense. So quite simply, adaptive rule is we adapt to the market. When the market shows that orange is below blue, we use that hard data and we exit the market and leave positions that would have exposure to the market. Right now, we continue to see orange above blue. The market's making a series of higher highs and higher lows. Regardless of what anybody's opinion or belief is, it continues to do that. We know some firms where they're communicating that that this won't end well. Well, that's a little bit like communicating that we can't go on vacation because that means vacation's going to end at some point. Yes, the market will trend and this trend will change. The market will reverse and will change at that time. So we'll react. We don't need to predict what the market's going to do. We have no idea what it's going to do. If you have someone telling you they do know what it's doing, probably run the other direction, because the only thing that matters is price itself, and that's showing us higher highs and higher lows and orange above blue, so the trend remains up. But like I said, this can always change, and when orange is below blue and the trend changes, we'll adjust. Now, jumping to the more near term, even on a weekly basis or in the past month, you know, there's been a lot of coverage about the Dow Jones passing 22,000. Here you even have a guy who's got a hat that's 22,000. Entertainment sure is a busy business, and round numbers, for whatever reason, human nature, we love our round numbers. You know, we celebrate double-digit birthdays, you know, midlife crisis birthdays, 40 years old, or over the hill, 50 years old. We celebrate these round numbers, and we get excited about them, you know, Y2K or the year 2000. And here we have Dow 22,000. And there's a lot of people talking about how big of a deal this is, and it is. The Dow Jones is an important index, but I think it's time we kind of jump into what and how the Dow works. And the Dow Jones is something that was invented. It's very much similar to the charts we were looking at before, where the S&P 500, which represents 500 of the largest U.S. stocks. The Dow Jones represents the largest 30 stocks, and it's actually not based on market cap. Largest is really how large is your stock price. And what do I mean by that? Because I want to clarify something, that when we look at the Dow Jones index, we have to be very careful that we don't only look at that index and somehow draw a conclusion that that represents the stock market. After all, how could it represent the stock market if it's only 30 stocks, whereas, for example, the New York Stock Exchange is somewhere near 2,000 stocks? That's probably even a better representation of the market as a whole. So this is a market of stocks, not just the stock market. And I think it's important to point out how the Dow operates. So here are the 30 stocks that are within the Dow Jones Industrial Average. And you're probably familiar with them, some of them like, Disney and Visa and JP Morgan Chase and Nike, Apple, McDonald's. These are all very familiar stocks. But what's interesting about how this index works is it's based on the price of stock itself. For example, Boeing is the number one weighted, so it has the most impact. So any price movement that happens with the stock of Boeing impacts the Dow Jones the most. And that's simply because the stock price is $238. And you might not be able to see it on here, but number 2 is Goldman Sachs, because it's got a share price of $229. Similarly, 3M has a stock price of $207. And United Health Group has a stock price of about $195. I think you get the point. So as you move down this list, it's the actual price of each share that is based on how each company is positioned within the index. Now you might say that seems a little silly, and I wouldn't say silly, because the Dow Jones is an important index. It goes all the way back to 1896 when a guy named Charles Dow invented it. And I understand his thinking, because he was just basically going to the paper and taking his favorite 30 stocks, or 30 stocks that he thought represented the U.S. economy, and he went ahead and just tallied the share price. That was the easiest thing to do, and since then that's held. Now, the Dow Jones is interesting because it doesn't necessarily reflect the same stocks that were back in 1896. What most finance people won't tell you is that indexes will drop companies out of the index all the time. So there's this thing called survivorship bias, which means this indexing gives you the perception that all stocks are equal and all stocks are doing well, when in fact these 30 stocks, only one of them is a remaining stock in the Dow Jones back from 1896, and that's General Electric, actually, and that actually was removed at one point and then put back in. So it's an interesting index, but be careful when they're talking about all-time highs, 22,000, this is awesome. Be careful, because it's not necessarily a great representation of the stock market as a whole, or a market of stocks. An example of this being, when we look at what happened with the Dow this past month, it made higher highs and it made all-time highs at past 22,000. That's good for a bull market. However, we need to understand that it was Boeing. Boeing appreciated 20% during the month of July. So during the past month, Boeing appreciated 20%. That means that it impacted the index itself, the overall Dow Jones. So when the Dow Jones moved up through July, almost 60% of that move was because of one stock, because of Boeing. And what's interesting is when you look at the market cap, so the overall market size of Boeing, it's actually ranked 41st. It doesn't even fit inside. If you were to if the Dow Jones was a market cap index, it wouldn't even be listed in here. When it's listed in the S&P 500, okay, it's the 41st largest U.S. stock. And so its impact, Boeing's impact on the S&P 500 is about 0.6%, whereas Boeing's weighting within the Dow Jones is 7.4%. So it has for the past week and a half, the S&P 500 has kind of moved sideways to down, while the Dow Jones has moved up, and it's really because of one stock. So when the news is telling you, Dow 22,000, what they really probably should be talking about is what Boeing did to move the Dow Jones up. So I just kind of wanted to go over that because sometimes when we see, we think of the Dow Jones as the market when it's not, and we think, oh, the market's making new all-time highs. Yes and no. The S&P 500 didn't make new all-time highs recently. Now, it did in the month of July, but it hasn't recently at the same time as the Dow. The two are heavily correlated, so I don't want to give a complete misrepresentation here that somehow things aren't well. But just to highlight that when the Dow Jones, if you're using the Dow Jones as your gauge of market health, just be careful that it's heavily influenced by stocks just based on their share price, with Boeing being the example in this case. And just to hammer this point home, here's the Dow Jones Industrial Average, and it's a near-term chart. Here's July to August, and more recently we've seen the Dow Jones make a series of higher highs. In fact, I believe this is 8 or 9 days in a row of higher highs for the Dow, and it's really heavily impacted by, for example, what Boeing is doing. Now there's some other stocks in there too, but Boeing was a big one. But again, from an overall perspective, orange is above blue, Dow Jones is a positive trend. That's great. I just kind of want to highlight this little move here and contrast it against some other popular indexes, see if there's any clues from that. So here's the Russell 2000. This is another index, but this one actually represents it's small cap companies, not your huge companies, but small cap, which are just as important to the overall health of the market itself. But you'll notice that recently, during the same time period that the Dow Jones was making new all-time highs, there were 2,000 other stocks represented by this index that were not doing the same thing. Now, trend-wise, orange is above blue. This is good. But we need to understand that there are 2,000 other stocks not making highs, and you could argue that there were 2 or 3 stocks making highs, giving you the impression, oh, the Dow Jones is making new highs, and so all is good. All is good when we look at the remainder of the data. All is good because there's 2,000 stocks where the trend is up, orange is above blue, not because just one index, the Dow Jones, impacted by a few stocks, is making new highs. But it's really interesting, this period here with the Dow Jones, I think up 9 days in a row. The Russell 2000 was actually down 8 days in a row during that, and that's something that's never happened before in history. So we just witnessed an 8 to 10 day period of history where the Dow Jones made consecutive highs while the Russell 2000 made consecutive new lows. Nothing big deal, just something to note. It was a historic moment. It doesn't have any market ramifications because we continue to see the orange above blue. If anything, it means maybe there's more money flowing into large caps than there are small caps. Same thing here. This is the S&P 500. This represents the 500 largest stocks, a little better representation than the Dow. But again, you can see, during this last week or so, even, last 10 days, market really hasn't done much. Yes, the Dow is making new highs. The market hasn't really done much. And then this is just kind of an update from the last video. We continue to see, price move in such a way where, down 3%, up 3%, down 2%, up 4%, down 2%, up 3%. This is normal behavior, this stair-stepping behavior where basically, buyers are stepping in at earlier levels. We can see demand for equity sooner and sooner. But we can see some downward pressure, and that's fine from time to time. But that's perfectly normal, and that's what gives us our trend. That's our price discovery from. So for a little nearer-term picture, orange remains above blue. The S&P 500 remains in a positive trend. I should highlight from a seasonal perspective. So when we look at markets seasonally and see how they perform during this time of year, August typically is what's called a low volume month, and we typically see the market chop sideways. Even the August September period of time, typically we'll see some type of price correction, and so a move where price is down 3% would be perfectly normal. That would take it into this area here. But even a 6% move is not out of line, and would actually fall still within the a 200-day moving average. Just a move like that in August and September would actually be perfectly normal. And the reason why we use the adaptive system is we can stay invested when the data says so. Because -3, -2, even minus another -3 or -6, those type of moves make investors nervous. We don't need to be, as long as orange is above blue. Now again, if orange is below blue, right? If the trend is down and price is then making a series of lower highs and lower lows. So if orange is below blue, similar to it was in 2008, well then obviously we would want to use that data and not be involved with the market. But the data currently is showing orange above blue, both trends are up. We can be involved in the market and generate return with that. And you guys might remember from last month's video that we can slice up the market in different ways. One of those ways, we can look at each sector and see how the health of that sector is doing. And so we're going to jump into a couple of those briefly here to kind of just give you an idea on how different slices of the stock market are performing. And so here's technology. In last month's video, we talked about technology and its importance to the overall market. And we actually were talking about it in a period of time where we had seen a price correction, but we had also highlighted that buyers had stepped in at certain spots previously, and the video was back in this period here where we had seen price drop, or what's called price discovery, and sure enough, buyers showed up here again and drove prices back up, drove technology back up. And so we continue to see that series of a new high here that's healthy, higher lows, and orange is above blue. Technology remains in a positive trend. That's a positive development. Now, that may always change. We could see, if price weren't able to hold something like this, that maybe we're going to have a further price correction below this level, but that would be perfectly normal. To see price make a move like this, maybe back down to an area where buyers were before. That would be perfectly normal. That would probably be something like a 5 or 6% move, but still within a healthy uptrend. And that's why we use the adaptive system, because it allows us to stay in moves even when there's drawdowns, which are perfectly normal, very similar to like tides of the ocean. Or I know a client that gave a great analogy of walking up a sand dune. When you walk up a sand dune to get to the top, you're gonna take steps up, and then there's gonna be steps that slide back, and that's just perfectly normal part of moving up a sand dune. Same thing with price discovery. And so I'm not saying that this is what's going to happen. Nobody knows. Just kind of giving you an idea as we head into August here, where the month can be weaker. But again, we could see price go ahead and make break above these levels here, and that would be perfectly normal too. Or we could just move sideways. But as long as orange is above blue, we can remain invested in that. And here's energy. We talked about this slice of the market last time as well. We talked about, this is a perfect example of, a series where orange is below blue, price keeps making lower lows, and that's just a perfect example of a downtrend and not something that needs to be in someone's portfolio. Now, we've seen it kind of perk up here a little bit recently, and it's going to be really interesting to see if this level here where sellers have shown up recently can be broken. And then that's something we'll look at as a potential option for a portfolio. But right now, it doesn't make sense to have it in a portfolio. So if that's something that you have in yours, you should, I can't tell you what to do, but from an educational standpoint, when in a downtrend like this, energy is not something that makes sense to own. And since I'm already probably going over time here, I thought I'd cover another one that we covered last time, which was emerging markets. And we continue to see it in a positive trend. So orange above blue and a series of higher highs and higher lows. Last time we talked about it was in a period, was actually right in here. And we talked about how we wanted to see buyers show up and support at these levels, which they did. and they went ahead and drove price above this level. So we continue to see emerging markets stair step upwards, as it's that's a positive characteristics for a positive trending market, and it continues actually to outperform U.S. stocks. So we continue to see strength internationally, and that's not something actually we've seen in over 10 years. It wasn't until about mid-2016 when that characteristic changed, when we started to see global markets participate in the rally. And so we continue to see things like Latin America, emerging markets, Europe, even China and some Japan picking up and being in positive trends and participating in a global market rally. Again, these things can change. We can see when the trend changes by using the adaptive system. We can see when orange is below blue. Now, again, we don't use those exact what's called moving averages. We use different ones, but we don't give away the secret sauce. But point being, emerging markets continues to outperform, continues to be in a positive trend, continues to be a place where one can remain invested. Maybe there's going to be a pullback, back to the 50-day moving average like this. If buyers can't support this level, that would be perfectly normal price behavior. We continue to see a positive development in emerging markets. And then one final thing I wanted to cover before closing down this month's update is a pretty important asset class here, actually, is the U.S. dollar. So here's the U.S. dollar index. And really what this is you could think about this similar to if you went to like a store and you were filling up a basket. Inside that basket would be the U.S. dollar, the Japanese yen, the Swiss franc, the Canadian loonie, the Aussie dollar, etc. All those things would be thrown into this basket. And then if you were able to look at this basket and see when the dollar was getting stronger, when it was getting weaker, that's what this index is. So here we're looking at this scenario where orange is below blue and we continue to see the dollar weaken. And I think it's kind of funny because I have this highlighted here with this red circle. It was right here when a very popular financial magazine, The Economist, released the Mighty Dollar magazine cover. And my point in this is that typically by the time the media gets a hold of something, that's when, as an investor or market participant, we need to be wary because the timing on this, a sentiment has reached an extreme. Now, you can't use magazine covers and newspaper covers blindly. It's a weight of evidence approach, but it's a classic example, this magazine cover taking place right as the dollar's at its strongest point here, and we've seen nothing but pressure against the dollar since that point. And really, what's going to be interesting here, and I think this is a really important development, if you take anything away from this video, is we've seen demand for the dollar in these places before, near this level, and here we are there again. And the dollar impacts a lot of different things. It impacts emerging markets, impacts commodities, obviously impacts U.S. stocks too. So what happens with the dollar right here is actually very important. Now, I'm not going to go ahead and draw some type of conclusions or predict. If it breaks through this level, we'll see what takes place then. This also would be a very logical level for buyers of dollars, demand for U.S. currency, for the mighty dollar to take place. So something to keep in mind. It might not be covered that much, but the dollar is at a very important level. It's not a fearful level. If it holds here, if it doesn't, that's not something to be afraid of. It's just something that will impact portfolios, and we're ready to adjust using the adaptive system based on that information. And again, as promised, we're always going to be looking at the big picture, identifying the larger trends. We continue to see the market be in a positive trend, orange above blue. We can be involved with the market. This can and will change. There can even be price movements that take place within that positive trend that are perfectly normal. And we use the adaptive system to monitor that for our clients. And if that's something you want to check out, you can go ahead and go to our website, clientfirsttaxandwealth.com. you can schedule an appointment with us. It's completely free. Come in and check out how we handle our financial planning, how we manage assets using the Adaptiv system. This kind of gives you a sample of how we think about things, how the Adaptiv system works. And if you want to check that out, you can come in. The website has our phone number too, and you can call and schedule that for yourself if you'd like. As always, we'll continue to stay disciplined to the Adaptiv system, using price as our guide. It's the only fact that matters. We'll use that to identify trends and positive relative strength. And when the market adjusts, we'll adjust accordingly and make sure that we're protecting from the downside. But otherwise, that concludes this month's video. Hope you guys enjoyed it, and we'll be back again next month.